The market just put up some huge numbers, but honestly, that's not the real story. Today, we're going to dig into what really happened on December 23rd, what it means for all of us, and maybe most importantly, what you need to be looking out for next. So, at first glance, everything looks fantastic, right? A big, strong rally to close out the year. But you and I both know the headline numbers never ever tell the whole story. The real game is understanding what's happening underneath the surface, because that's where you find the true risks and the real opportunities.
And you know what? We're not going to make you wait for it. We're flipping the script and starting with the conclusion first. Here is the single biggest takeaway from today's market.
So here it is, the bottom line. Yes, this rally is the real deal. It's not smoke and mirrors. It's being powered by some seriously good economic data. But, and this is a big but, this is not the time to get complacent. There are some major risks bubbling just under the surface, which means that from here on out, success is all about having a cool, disciplined, and analytical plan. And we're going to show you exactly what that looks like. Okay, so what was the rocket fuel here? What exactly happened that got investors so fired up as we head into the new year? Well, the answer comes down to this idea that economists are calling a Goldilocks economy. You know the story, right? Not too hot, not too cold, but just right. And for the market, it's the perfect scenario. And this number? This number is the hero of the entire story. This was the Q3 GDP growth. Now, Wall Street was expecting a pretty good 3.3%, but the economy came in and delivered 4.3%. That's a massive beat, and it showed everyone that the U.S. economy is way, way stronger than almost anyone thought. So this is where the magic happens. You've got this incredible economic growth, and people are out there spending money, which is amazing for companies. But, and this is the key, at the very same time, inflation is cooling off. That drop in inflation pushed bond yields lower, which in turn makes stocks look way more attractive. High growth and falling inflation, that combo is like pouring gasoline on a fire for market rally. And here's what that perfect recipe cooked up. All three major indexes finished strong, but look closer. You see the NASDAQ leading the way with a 0.6% gain? That tells you that the big tech names, which had taken a little breather, came roaring right back as soon as they saw this good news. But here's where it gets really interesting. Those green numbers on the screen, they're hiding a much more dramatic story. Because under the hood, this market was a battlefield with very clear winners and very clear losers. And you couldn't see this split more clearly than in the retail world. You know the old saying, it was the best of times, it was the worst of times? Well, that was the holiday season for these companies. I mean, just look at this contrast. It is night and day. You've got Walmart, whose ad sales just exploded, up 53%. That's a huge sign that they're figuring out how to turn their massive customer base into a whole new profit machine. And then you've got Nike, which came out with a really disappointing report that just crushed the stock's momentum. Same industry, two completely different worlds. And this wasn't just happening in retail. Oh no. We saw this exact same dynamic playing out in the high-stakes world of tech and electric vehicles. And again, it's just so stark. NVIDIA, the undisputed king of AI, just keeps climbing. Another 3% jump because demand for their chips is just unstoppable. But then you look at Tesla, and they are facing some serious new competition. In Europe, a huge market, their competitor BYD saw sales go up by an incredible 222%. That's market share being taken away, plain and simple. Okay, so that's the lay of the land right now. That's what just happened. But the real question is, what comes next? So let's shift gears and look at the key risks and opportunities that should be on every single investor's radar. So on the risk side of the ledger, there are three big ones. First, you've got some uncertainty at the top. The Fed chair's term is up in May, and who knows what a change there could mean for interest rate policy. Second, valuations, especially in tech, are really stretched. And third, let's be honest, after a run this strong, the market is just naturally more vulnerable to a pullback. But it's not all doom and gloom, not by a long shot. There are some massive tailwinds here too. The AI revolution is really just getting started. The market is basically betting that we'll see interest rate cuts next year, which would be a huge boost for stocks. And that super strong economy we talked about, that should lead to some really healthy corporate profits. Okay, so that's the big picture. But what does all this actually mean for you? Let's break down some potential game plans based on what kind of investor you are. All right, if you're in this for the long haul, right now it is all about discipline. This is the perfect time to look at your portfolio and rebalance. If tech has ballooned to a huge part of your holdings, maybe it's time to trim a little.
Set some rules for yourself now about when you'll take profits so you're not making emotional calls in the heat of the moment. And you might want to consider a defensive play, like gold, just to smooth out the ride if things get choppy. Now, for you traders with a more medium-term view, the name of the game is agility. You need to be watching those inflation reports, the PCE and CPI data like a hawk, because that's what the Fed is watching. Be ready to pivot and rotate into different sectors as leadership changes. And get your homework done now for the Q4 earnings season, because that's right around the corner. And hey, if you're new to all this, first off, welcome. The most important advice is simple. Keep it simple. Don't get swept up in the hype. Just stick to the basics, like diversification. Use this time to learn, not just to trade. And start small. There's no better teacher than real-world experience, but you don't have to bet the farm to get it. You know, this all comes down to one of the most powerful ideas in investing. Psychologists talk about two ways our brains work. There's system one, which is your gut reaction. It's fast, emotional, and intuitive. And then there's system two, which is slow, deliberate, and analytical. When a market is booming like this, it is so easy to get caught in that emotional system one thinking. The real key to winning, though, is forcing yourself to stay in system two. So I'm going to leave you with this one question to think about. When you look at your own portfolio, when you think about your next move, is that decision coming from an emotional place, from fear or from greed, or is it coming from a calm, analytical plan? Because I promise you, the answer to that question is going to determine your success more than anything else in the year ahead.